Here we are now. We're going to talk about what's happening abroad. What are the expectations for storage? You know, when we started doing some of what things were looking like back in June, you know, we saw things getting not seeing the same accelerating draws that I think others were seeing in Q4, just because we saw some slowdowns in exports coming out of the U.S. You know, again, some of the warning signs we were seeing from the physical market. And then when we look out into 2022, we always saw some of these accelerating builds because it came down to where's supply, where's demand. And now, in typical fashion, the agencies are seeing something similar. It just takes them a little bit longer to get there. They have more data. They wait for things to become a bit more stable. So I have to give a shout out to Shales from the Crypt, or Viscosity Redo, who was able to put these together for me. Again, he just wanted to look at where things were going. I should say he or she. You know, we don't know I shouldn't generalize. So when we look at where things are right now, here's just giving you an idea of what the EIA STO came out with. So this is what their expectations were. So you can see that they have draws in November, December. They're not as aggressive as previously expected. And then the shift is really when you start looking at what are the expectations into 2022, which is why when we were saying that the data came out a bit more bearish than expected, that was when then that meant that, you know, Biden couldn't use that as an excuse to increase the SPR, which obviously sent crude up too. So in normal market fashion, you had bearish data come out, or bearish pricing, but obviously it became bullish. So then bullish flip bearish and bearish flip bullish. And it's always the fun things that happen in this market. So one of the things that also happened last week is the OSPs, or the official selling price that is coming from the OPEC nations. So Aramco increased pricing for its key Arab light grade of crude for Asian customers in December. It went from $1.40 premium to $2.70 to a premium of $2.70. Now, there was always expected to be an increase. There normally is an increase as you go into December. There's more demand. You're out of shoulder season, but the expectation was from $2 to $2.25, with a lot of people shaking out at $2.13, $2.15. So to go up to $2.70 is really big when you think about refiners sitting at this apex of just pain, where demand is starting to come back, not there yet, but still getting better. But you still have crude prices that are just going to crush them, because again, these OSPs are going to impact them directly. In the comment section the last week, I kind of broke down what it takes for a cargo of West African crude to get into Asia. And I just wanted to show what that timing is, how when we're talking about a barrel of oil, a cargo of oil loading in November 28th, you're not seeing that as product until March 14th. And those are the important dynamics. So that's when you start looking out into March and April, that you can get an idea of kind of where things are sitting. And if there's a big surprise to the upside, they have to rush out and buy additional crude, because then they're going to have to refill what that storage looks like. So that's why it's important to look at not only just what is happening near term, what is happening in the physical market, which is kind of that medium term, and then what are the futures market or the paper market showing, just based on, does it make sense? Is there contango there? Is there backwardation? So this is something that has been coming out. And one of the things that, when we say, a square peg that we can't round, is why are light sweet, medium sweet crude just not selling based on where the demand is? And that's something that I can't get a good answer. And there's nothing, no matter how hard I try, no one has a meaningful response. So if you have a theory, I would love to hear it. This is not, no one's right or wrong. This is just what would your expectations be. So I would love to get some of that dialogue going. And then when you look at, just what the expectations are, so excluding a brief period last year when Saudi Arabia and Russia were coming out of a price war, the month-on-month price increase for Arab light to Asia is the second largest in 20 years. Now, they're not the only ones. We had Libya taking it up. We had Iraq go take Basra light to $1.50, and increase it to Asia by $1.50, going from to $1.95. The one that's the most interesting is the Mediterranean and Europe, where there's a lot of that kind of stress in terms of where things are. And that's where they should really try to be going, because the Mediterranean has they're the brighter spot if you think about where refining is right now. And they increase prices across the board. So again, it's just going to make it harder to go through. So far, we have, Saudi Arabia has made full allocations to two entities in Asia, 3 entities in Europe, and the rest are either still waiting or just have not made an allocation or indicated what their allocation will be. So this is going to be something to watch, because again, even though the OSP is posted, it doesn't mean that it'll cross at that. It could start at an elevated level. So for an example, like the Saudi Arab Light, the conversation starts at 270. Sometimes it trades up, sometimes it trades down. Like we talked about last week, we had Iraqi crude that was initially trading at an elevated level, and then it came back down. So it just comes down to where do we see some of these flows. So that it's important to think about what are those flows. And when we discuss what happened in Iraq, so Iraq had some of their crude, SOMO was trading at a steep discount to OSP, then it went to a premium, and then it kind of settled out 20 to 30 cents at a bigger premium. So that again, some of that impetus to increase rates, but this is a very large increase for kind of where refiners are sitting and the struggle they're having just with obviously natural gas prices, hydrogen prices, which is why, based on natural gas prices, hydrogen prices, it would incentivize you to buy more medium sweet or really sweet crudes in general. But that's where we get some of these deviations. So this is looking at the EIA. Now, when we turn to OPEC's release, this is what OPEC has for Q4, Q1, Q2. So you can see, again, those builds as we get into Q1 and Q2 on the supply-demand backdrop, and where they see some of that those builds as we go into next year, which is what they're using as the reason why they're not increasing production above that 400,000 barrels a day. But at the same time, coming full circle to our conversation, when you look at the West Africa can't sell their crude at a reduced rate. They're over compliant, but they still can't sell where they're over compliant. So everyone keeps talking to it's like, oh, well, they can't reach it. It's like, well, maybe they can. This isn't a comment of if they can or can't. There's no impetus for them to do it because they can't sell what is currently in the water. So why are they going to produce at their max and put more on the water where they're already at a record amount in floating storage? So again, this is those conversations of the narrative versus the data, and there's obviously truth in both. It's just a matter of what wins out, and obviously in this market we know what narrative means. So then when we look at OPEC wellhead production, here's the so when we look at the total, the compliance is at 115%, and the reason is when you go through the different backdrops, Nigeria is 222% compliant. Angola is 247% compliant, and Congo is 157% compliant. So you get an idea of why they're so compliant, and it's really just based on how those countries just are not producing at the level that they're allowed, but at the same time, they're not seeing the demand or the selling that tells them to increase their production levels. Then when we look at Russia continues to produce, above their allotment. They're 91% compliant, where the rest, so total non-OPEC, is 107% compliant. Malaysia is over compliant. I guess, Iran is just flying their own flag, so they don't need Malaysia. But again, these are some of the different backdrops and shifts that we continue to see. But this will be important to see, okay, well, what does November look like? And that's why there's a difference too between production and exports. Because when you look at how cool some parts of the Middle East have been, as we talked in segment 1, there's more high sulfur fuel oil that is now on the water. There's more product, which means that there'll be more crude just because they don't need to burn as much for electricity. They don't need to burn as much for just local demand, which then just slates more to go into the open market. So then when you look at OPEC production and quotas, this gives you an idea of kind of where production is. And it's important to discuss kind of where production was July 2019, January 2019, again in February of 2020, we were at 28 million barrels a day. So right now, with us being at 23, there's abilities to get back to 28. The question is, where can we get above that? And that's when you get into the discussion of what is spare capacity, how much is available, and really where do we sit? Because OPEC production continues to sit below the quotas, but a lot of that, or really all of that, is being carried by the West African nations. Now, when we look at Chinese crude oil imports, they slumped to a 39-month low in October as they opted to try to work through a lot of the excess capacity they have. They're back to the February levels of crude. So it's just, if you think about when they had their COVID outbreak, December, January, they're getting right back to where they were on that pre-COVID side. But it's just a matter of where do we see things going. So China's crude stock fell to the 20-month low of 825.76 million barrels last month. According to data, the previous low was 808.44 million barrels in February of 2020. So they're still about 20 million above where they were in February of 2020. There's still some of that capacity. So they could have another month like this and work through some of that additional capacity given where prices are. And they're not increasing teapot import quotas. That is going to become another issue, because the other component of West Africa, and why we talk about West Africa so much, West Africa is the first area to post their loading schedules. Angola's the first, Nigeria's the second, Congo's the third, and then you have North Sea. You have Europe, you have Russia, you have Libya. So they're really the first. They give you kind of the bellwether of what is it going to look like, and then the speed at which they sell and the price at which they sell kind of sets the stage for how the rest of the exports will look for that loading schedule. So that's why we talk so much about West Africa. It's the best quality. We always call it the Goldilocks, if you will, of that medium sweet, where it's heavy enough to make all the products. It's sweet enough to not have to worry too much about sulfur. And this is really why we talk so much about that level. So then when we start looking at China's preliminary oil imports exports, so here you can see that you had a big drop in October so you had a drop year over year by 11%, month over month by about 8%. Oil product imports ticked up a bit, but against last month ticked down by 2.8%. And then when you look at oil product exports, they came down sizable to they dropped 31.8%. Month over month, they dropped 4.6%, because remember, there were restrictions put into it. Gasoline has now seen some of those restrictions lifted, but we still have them on diesel, so that'll keep things overall, let's just say net the same. About 18 million barrels discharged from floating storage near China. Again, that's why we've seen some of that floating storage move onshore, and that will be replaced overall. Now, when we look at just generally speaking on January through October, where do we sit versus the previous month? Crude imports were down the previous segment of January to October 2021, October 2020. Crude imports were down 7.2%. Oil product imports were down 7.1%. Oil product exports were up 3.8%. That will continue to whittle down, but net for the year, they will still have exported more than they have imported. So again, you're still seeing some of these shifts overall, and that's why it's important to look at China. Now, when you look at India total oil demand, you can see that it had its first positive versus 2019. So India's oil product the consumption in October rose 0.8% year over year to 17.9 million tons, the highest since March, according to provisional data. So gasoline consumption was up 3.6% year over year to 2.75 million, which is, again, a positive. But diesel consumption was at 6.61 million tons, which is 5.6% below year over year and down the most since February. So that's a bit concerning, because you had Diwali. So typically you have a lot of activity happen before the holiday just to make sure that you have enough stuff, like everything starts moving. Everyone wants to get everything done before they go celebrate the holiday. So the fact that that's down is concerning, and that is something that we're going to watch. Naphtha consumption was down 5%. LPG consumption was up 2.8% to 2.49 million, and petcoke was up 4.5%. So realistically, the demand setup was driven by gasoline, LPG, petcoke, but naphtha and diesel remain the headwinds, and both of those are very much industrial uses. So those are going to be kind of the pieces, and obviously diesel's the biggest piece of it, as you heard from, the others are about 2.7 million tons, where diesel consumption, even at a reduced level, is 6.6. So diesel's going to be the biggest one. That's how is the economy doing? How is growth looking? That's, I think, an important one to continue to look at. Now, when we look at product exports in the U.S., so we had gasoline exports increase 73,000 barrels, just below the average. We expect that to continue to move with the seasonal norm. Distillate had a nice spike of 211,000 barrels a day. That's 48,000 above the 5-year average. We expect that to cool off, but still remain elevated, just given obviously that disconnect, as we've been talking about with high sulfur fuel oil and the rest of the market. They're going to need to move some of that out, so that'll keep distillate exports elevated. Propane had a nice spike of 499,000 barrels a day, just blowing through the 5-year average, and we expect that to remain elevated. And then total crude exports increased by 128,000 barrels a day to just over 3 million. That's something that, again, we expect that to be lumpy, but that will come back down. So Middle Eastern oil product flows into Europe, mostly middle distillate, are poised to climb. That's going to continue as we have more coming for the gas oil side. They're showing up. It's just a matter of timing delay just based on when they actually appear, but they are in the water en route. WTI versus Dubai still remains expensive, still about $5.27 more expensive, which again is just going to keep things a bit stagnant and keep countries from buying from the U.S. and more focused on buying from the Middle East, especially even with the OSP. It's just there's that's why exports are important. There are a lot of exports. There's exports available. And remember, Merbane is freely floating. So there's an ability to kind of capture some of whatever is in that free float and try to get the best price possible. And then the same thing is happening in Brent, we're having that elevated amount of capacity. Now, the elevated price versus Dubai. Now, Indian oil company, the IOC, seeking to buy mostly West African crude grades for December 22nd to 31st loading. So it's going to be important to see how does that develop. Is India buying more? Right now, they've been fairly sluggish in what they've been buying. But this is something where if they continue to see an acceleration of demand, we should see them coming in more aggressively, especially to get some of those West African grades. Gasoline, as we were saying, we expected it to be just right on the 5-year increase along the 5-year average. We don't see that adjusting right now, especially with Latin America seeing some increase in demand. Distillate had a nice spike above the 5-year. We expect it to fall just below the 5-year and then just stick fairly closely to that 5-year through really the end of the year, just based on where the demand cycle sits. Ethane exports hit a new all-time high. That's going to continue to be the case. As we said in segment 1, we have more ethylene production happening in China. They're going to be pulling in more ethane, which is going to come directly from the U.S. Crude exports, here's one thing that we expected just to be sideways, just trend a little bit lower. As we've been saying, right now the 4-week rolling average is about 2.956 million barrels a day, and we expect it to settle a bit lower at about 2.8. Total U.S. propane is hit a new seasonally adjusted all-time high and got close to the high for 2021. But as we look forward, China and India are talking about turning a bit more to Middle East for LPG supplies, cutting into exports from the U.S. Asian buyers have been deterred from increasing U.S. Gulf Coast purchases due to congestion uncertainty over the Panama Canal. Obviously, waiting times, supply chains, shocker, are an issue. As rules introduced on the route this year also mean that LNG and container ships are given priority. So again, more impetus to not go after U.S., but some of the other cargoes. Asia demand for LPG is forecast to increase by 310,000 barrels a day next year, with about 70% of that coming from China. And then Iran could become a bigger part of it, depending on obviously where things sit and how that plays out. The Genscape had another small decline. We expect this to reverse, just given obviously where the amount of crude is sitting. When you look at offshore storage, onshore storage, it's just going to be that pivot from one to the other. Now, when we look at flows, we had drops in storage across the board. When we look at gas oil is back to the lows for 2021. There is more unloading happening, so we do expect this to reverse, but again, just stay fairly tight and go sideways over the next few weeks. Gasoline started to dip a bit, but still now above that 13-year average, and we expect that to remain elevated as exports into the U.S. remain low, and gasoline demand slows down a bit in Europe along seasonal lines. And then fuel oil still remains elevated, but coming down slightly as, again, exports accelerated into the rest of the world. When we look at what happened in Singapore, we had a drop of a little over 2 million barrels in storage, both of which were driven by middle and light distillate as resid actually increased. So when we look at international, the total, we're right back to the 15-year average, and we expect that to bounce. But again, just stay fairly tight and just go sideways with not just meeting the previous highs, meeting the previous lows. As we see some of that new demand coming on, we also have new supply, and that's pushing more into the international market, even as China takes some off the water. Here's where you got that big drop. So light distillate was to the lowest for 2021, right to that 15-year average. We expect that to bounce back up to the previous low prior to this drop, and then again just stay going sideways. And then when we look at middle distillate, we see that drop. It'll come back, especially when you look at Fujairah that had a big increase. That's what we're seeing, just some of these increases as some of this product shifts gears and shows up in different locations as residual continues to trend higher. So China's keeping the same import quotas for private oil refiners, which is something that they were actually importing a decent amount of fuel oil. And the fact that they're not going to import all that much, you're still seeing some of the oversupply of high sulfur fuel oil. That's keeping this fairly bid, and we expect to see some of these increases again in the Singapore data that comes out tonight. Now, when we look at total loading schedules, you can see for November, there's still Nigerian and Angolan cargoes available in November, which is, especially for Angola, is very rare. But you're starting to see those increases for December as December loading schedules are getting finalized. Nigeria is right now at about 1.3. That should be closer to about 1.5 based on deferrals and what is final. And Angola is ticking up again. Libya came down a touch. They should sit at about 1.06 in November. We see something similar in December. Maybe a slight reduction to 1.03, but again, they've actually increased production to about 1.3 million. So that could but they also have to refill storage because there was that timing delay when they had a pipeline leak. They had some issues with some infighting, and then there are some issues again on a political side. But so far, they hit 1.3. Some of that will go to refill storage, and they should be able to maintain their normal flow rates. So here you can see just fairly stable all the way through, with Russia seeing a bigger increase. Angola sales, just going through some of the different numbers right now. So right now we have some November loadings have started to move. The sale leaves around 2 cargoes. So we had 4, we're down to 2. That is, again, still elevated. Separately, Angola loading recently traded for $1 more than dated Brent. And just to be clear, that is below where it had previously traded, which was at $1.20. More than dated Brent, and then even before that, $1.80 to $2.15. So you saw how they're reducing those prices to try to incentivize some of those purchases. Demand for light sweet grades in the Mediterranean has shown signs of cooling amid narrowing refinery margins, high differentials, and that wide Brent to Dubai spread. So continuing to see those shifts, while Caspian CPC blend shipments are rising to a 21-month high to 1.47 million barrels a day in December. And Libyan exports for November will be at 1.07. So again, you're right in line with what we were expecting. Gunvor took away one of their offers at for euros at 1.55 less dated Brent. It had previously been put on for 140 less dated Brent. And remember, they try to spike it at the beginning of the month, and then they slowly walk it back by 10, 15 cents. So go to 140, then 155 to maybe 165, and then you kind of get that walk back. Nigeria recently offered $1.70, $1.85 more than dated Brent, slightly below OSP, but it still compares to the premiums that they were offering at $1.50 to $1.70. So we're starting to see a little bit of movement. Actual trade prices have been adjusted, but prices are likely to fall in the coming days as unsold December cargoes as a new loading program for January should come out this week. So again, you're starting to see those pressures as they're like, well, we still have November, and we still have December, but we're going to talk about January, and that's where some of those pressure points continue to come in to the cycle. Now looking at Fujairah, Fujairah actually had a fairly sizable increase. So total oil product stocks in Fujairah came in at 19.85 million. That's an increase of 4.266 million. We were expecting a build, but this is bigger than what we were expecting, and it's more because Middle Eastern demand has come down a bit. And that's because demand still remains fairly strong, it's just where the demand locally wasn't there, so that puts more in some of that storage. Light distillate, and by demand, I mean exporting demand versus local. So stock of light distillates rose 752,000 barrels to 5.67 million. Asian gasoline cracks remain strong. Bullish momentum emerged from the West again, so we should see some of those shipments. It's just that local demand is the problem. Stocks of middle distillate, including diesel and jet fuel, rose 399,000 barrels to 3.679. The Asian gas oil market remained supported as good demand and lean supply continued to promote fundamentals, which, again, we've continued to see with some of these activities. Local refiners staying fairly strong, while we're getting some of that, again, softness locally, which is pushing more into the international market. And then heavy resid rose by 3.115 million barrels. And this is a reversal of last week's fall. Spot trading activity at both the bunker hubs of Fujairah and Singapore were very lackluster, and demand is quite muted as the market is quieter compared to the previous days, as prompt deliveries command of 0.5% sulfur command good premiums amid logjams at terminals, possibly due to an increase in vessels calling at Singapore. But then when you look at some of the high sulfur, you're seeing a lot of that weakness, which is indicative of not only just that gas to oil switching, but also what some of the demand is on the shipping side. Crude oil in the water, big spike. We're seasonally adjusted. We're right at the highs. And it's just because there's so much crude now in transit, and there's still that elevated amount in floating storage, which again we expect to continue to show up at the floating storage sites as these transit vessels normalize. Here you can see we're right above the 5-year average. That is continuing to grind higher as more of these floating storage cargoes go into motion. But even with that, you can see we're still at very high levels, and we see that continuing to move up as crude that has been in transit for the last few days start to show up. You still have those port congestions. So again, floating storage will remain elevated, and it'll still be at 2021 high levels. Time spreads in Brent have come down a bit, but still, again, showing just how deep in backwardation we are. Shandong, as we were saying, when we looked at what's happening in China, state-owned refiners still slow to activate, but we have Shandong right just below 2021 levels, and we see that staying the same through the end of the year. When we look at December, finally starting to get a drop in WTI. We have to adjust this for Brent because obviously December 21 has fallen off the board. But when we look at the U.S. right now, this is what we've been talking about with what December showing, what next December showing. And there's still that steep backwardation that is within the system. Singapore, as we were talking about, crack spreads continue to come down. A lot of weakness has come through. We've seen in the U.S. back to the 5-year average on the Gulf of Mexico. And the same is playing out in Singapore. And the OSPs increasing is not going to help the situation at all. And here's where we look at hydrocracking, again, coming back to that norm. But this doesn't even include hydrogen, natural gas prices, which, again, bring this even lower and putting that additional pressure, while Northwest Europe still has some of that premium, which is why we were surprised that Saudi's doing what it's doing instead of trying to compete more in the Mediterranean, because that is where we see some additional opportunity. Urals, especially on the Mediterranean, going further negative for some of that lighter end as the heavier end still remains elevated. So again, you're still getting incentivized to make that gas oil, even that fuel oil, because that you can sell that back into the market. China's supertanker crude imports, moving back up, still below the 5-year average, but just based on what we're seeing, this will increase over the next 3 weeks. Asian floating storage going sideways. Again, we expect this to start to grind higher as the crude that was in transit shows up and is just replaced what is pulled off the water. So still remaining at those highs. North Sea came down a bit. We still see that being elevated as Fortes is still struggling to clear. So this is where we will see this just, again, track closer to the 5-year average. West Africa, again, still seasonally adjusted all-time high, still at one of the highest levels for 2021. Again, just can't move, which is why those discounts are going to continue to roll through. While the Middle East still remains elevated for this time of year, and now that you have more capacity coming online with the increase in quotas, you have OSPs. Some people might opt to not take. This is going to be an important one to watch, because as this grows, they're going to be incentivized to cut pricing against OSPs, which, again, this is going to be the tell to how much are they cutting. Are they cutting yet? If this stays flat, they'll do nothing. They'll just continue to move as is. But as you start to see these floating cargoes accelerate, that will this will be the kind of that good tell. And then when we look at Europe exploding to the highs, seasonally adjusted all-time high, highest of 2021. Again, that's why we expect to see more of that pivot from offshore to onshore. And then when we look at China, Shandong is right back to 2018 levels. Still off the highs from 2021. But again, you're just seeing some of the capacity, some is coming onshore to be replaced offshore. But when you look at teapots, they didn't get an increase in quotas for next year. They got a small increase this year. So again, you'll start to see this come through, but they'll start pulling down some of that excess of stock as fuel oil still remains at seasonally adjusted highs and still towards the highs of 2021. So I know we covered a lot. If you have any questions, please let us know. There's a lot of interesting things happening right now. The market is very wide open in terms of interpretation. So if you have, you can find me on Twitter or obviously on the comments section. We appreciate it, and we hope to hear from you. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.